A big headline crossing the Bloomberg terminal.
A big headline, quite the headline, John, for two companies that the U.S. government has a vested interest in. In a statement, we heard from the NVIDIA CEO Jensen Huang, who called this a historic collaboration. As part of the deal, Intel is going to use NVIDIA graphic technology in upcoming PC chips, and NVIDIA will use some of Intel's processors in order to meet the demand from AI data centers. The idea here being that they're really going to work together when it comes to some of this chip development. And it follows, of course, a recent push from this administration to bolster the domestic chip supply chain. Of course, last month, President Trump signing that deal that gave the U.S. government a 10% stake in Intel in a bid to sort of repurpose some of the existing CHIPS Act money. And I'll also point out that Japan's SoftBank made a surprise $2 billion investment in the company last month, too, amid this mounting pressure from the administration for this sort of money to be put up in order to clinch these trade deals. Now, I do want to point out one pretty important stat from this story that's now on the terminal. Analysts estimate that at some point next year, NVIDIA will pull in more revenue per quarter than Intel gets in a year. Of course, John, as you well know, this White House, this president has really shored up ties with NVIDIA as the company now finds itself really at the center of some of these sensitive trade negotiations.
Lisa, this is a really important development. You just listened to what Tyler was talking about there and the president's involvement in all of this. What's his objective? Build out domestic foundry capacity. One. What needs to happen after that? Someone needs to use it. And we've been talking about this over the last month. Who would be pushed to use it? This is not about the push anymore. NVIDIA essentially is telling you they're ready to use it. They're ready to partner with Intel to make this happen.
Yeah, and specifically on certain chips for PCs and other devices. The question is whether this is going to be a big effort or whether this is going to be more performative. And this is something that we've asked when it comes to China and the Huawei move earlier. This idea of, is the technology comparable? Or is it going to be tough to move away from, say, TSMC and Taiwan for the U.S. chip manufacturers?
Intel, higher again, up by 18% in the pre-market. Anne-Marie on the ground in the UK. Anne-Marie, I imagine this announcement is music to the ears of the president.
Absolutely. The president has almost become, a co-CEO of Intel, putting a lot of pressure, one can imagine, on a lot of these companies since, as Tyler mentioned, almost 1 month ago to the day, the U.S. government decided to take that 10% stake in Intel. And the question, Jonathan, you, me, and Lisa sat around the table and asked, who is going to be next to either buy these chips from Intel or invest in more money to make sure that Intel could once again become a national champion? So on one front, you once again have what many would maybe call unconventional, what the U.S. government did. But certainly this is going to mean that more support could be flowing into the company like Intel. And then to Lisa's point, what did we hear today out of Huawei, out of Beijing? This highlights a core issue for the United States. Huawei basically announced a multi-year plan to take on the dominance NVIDIA has in the marketplace. Howard Lutnick, the Commerce Secretary, has said time and time again, we have to make these chips in the United States. We have to make sure we are a dominant player in this. We cannot lose to China. Jensen Huang told me himself he doesn't feel like China's behind. They're right up against them in terms of where they are in the market and in AI technology. And the Commerce Secretary has said we have to make these chips in the U.S. We can't rely on Taiwan. So from a national security perspective, this really is in line in something we've seen from this White House. And once again, highlights, I would be absolutely shocked if the president and his team had no influence on this, highlights the heavy hand they are really taking in the semiconductor industry.
The GPUs from NVIDIA are essential AI computer components. According to management, spending on AI will increase quickly until 2030. During the current AI arms race, NVIDIA has been among the finest stocks to own. However, given that it is the largest corporation in the world, some investors might be reluctant to purchase shares at this time after its remarkable performance. Given that the AI arms race is still ongoing and that expenditure on AI is predicted to continue for many years to come, NVIDIA appears to be a wise investment. Is it the ideal stock to purchase right now, though? Graphics processing units, GPUs, which are computational devices capable of carrying out several calculations at once, are produced by NVIDIA. Since GPUs can be linked in clusters to enhance this effect, they have been the main computing device of choice for the majority of AI hyperscalers. Hearing about data centers with 100,000 or more GPUs is not unusual, And since NVIDIA dominates the industry and most estimates place its market share for data center GPUs at 90% or more, this translates into enormous sales for NVIDIA. Despite a little slowdown in recent quarters, NVIDIA's revenue growth over the last few years has been phenomenal. Nevertheless, a revenue growth rate of 56% is hardly cause for concern. Many businesses will never be able to grow so quickly, but NVIDIA consistently does so. Furthermore, NVIDIA's fast growth rate might continue to be high for a while given management's predictions for the market trajectory. The primary concern with NVIDIA is not whether it can continue to dominate, but rather whether the AI hyperscalers can keep increasing the amount of money they spend on AI infrastructure. Although data center capital expenditures have already reached a record high this year, many AI hyperscalers have already warned investors that 2026 will see even more spending. This is consistent with the projections made by NVIDIA's management to investors during its Q2 conference, called that global data center capital expenditures will amount to between $3 trillion and $4 trillion by 2030. The main four AI hyperscalers are expected to spend approximately $600 billion by 2030, according to NVIDIA, which is a huge increase. According to Wall Street, NVIDIA will make around $206 billion by the end of fiscal year 2026, which ends in January 2026. This means that NVIDIA will receive almost one-third of all data center capital investment expenses. According to that reasoning, NVIDIA might be making between $1 trillion and $1.3 trillion by 2030. That would suggest a low-end compound annual growth rate, CAGR, of 37%, which is an extraordinarily remarkable growth rate to maintain over that length of time. Without a doubt, NVIDIA would be the greatest stock to own at this time if it could accomplish that. But I think it's a good idea to include some conservatism in these calculations. Assume that the market opportunity is half of the $1.5 trillion that management has projected. Even with a one-third market share, NVIDIA's CAGR would still be 19%, which is much greater than the market's average growth rate of 10%. Even if NVIDIA might not be the best stock to purchase now, this growth rate would still make it an excellent investment. As long as investment in AI infrastructure remains high, NVIDIA is one of the best stocks to own. According to NVIDIA's management, this trend is expected to continue until 2030 and beyond, so investors may still profit greatly from one of the most powerful corporations in the world by purchasing today. Due to its domination in the AI hardware business, NVIDIA is already the most valuable company in the world. The level of competition is starting to increase. NVIDIA is one of the best examples of the stock market's ability to create millionaires. As enterprise clients rushed to accumulate its cutting-edge graphics processing units for running and training AI algorithms, shares have soared in recent years. Nevertheless, the chipmaker is already the most valuable corporation in the world, with a market capitalization of $4.1 trillion, casting doubt on its capacity to generate wealth going forward. To try to predict what the future may hold, let's examine the benefits and drawbacks of this well-known growth stock in more detail. No business can continue to develop at an unnaturally high rate indefinitely. Things eventually slow down due to issues like market saturation, competition, and technical advancements. Additionally, NVIDIA is not an exception to this pattern, which investors should not expect. Early indications suggest that the company's rapid growth is beginning to level out. NVIDIA's second quarter demonstrates how the story is evolving. Even while revenue increased by a remarkable 56% year-over-year to $46.74 billion, this represents a significant slowdown from the previous year, when revenue increased by an astounding 122%. This slowness is due to a number of factors. The most significant and least concerning factor is that comparisons are becoming more challenging. The percentage change will eventually fall, even if a company's overall sales are increasing by the same amount. Additionally, competition is starting to increase. Even though NVIDIA has so far been able to hold off competitor chip experts like Advanced Micro Devices, its own customers may pose the worst threat as they want to diversify their supply chains and lessen their need on its technology. Alongside NVIDIA hardware, cloud computing behemoths Google, Amazon, and Microsoft have all made investments in their own proprietary chip designs. The greater danger, though, might come from specialized AI chips that are more affordable and more suited to particular workloads than NVIDIA's all-purpose options. According to Reuters, OpenAI, the company behind ChatGPT, plans to introduce its first own AI processor in 2026 with the assistance of manufacturing partner Broadcom, which could lessen its reliance on NVIDIA's hardware. As its clients seek to vertically integrate their AI supply chains, NVIDIA will encounter long-term difficulties, even in the best-case scenario. However, that is predicated on the demand for AI remaining strong, which is by no means certain. The growth story of the sector is starting to show early fractures. According to a study published in August by academics at the Massachusetts Institute of Technology, 95% of generative AI pilots did not produce significant benefits for businesses. According to Futurism magazine, as of July, the greatest AI products can only accomplish 30% of real-world office duties, with the bulk performing noticeably worse. These discouraging figures may be the result of the technology's existing limits. As hardware advances and AI engineers iron out the wrinkles, investors should anticipate an improvement in the performance of AI tools over time. However, money speaks. Additionally, businesses may cut down on their software spending if they do not immediately see a significant return on their AI efforts. Being on the pick-and-shovel side of the generative AI market, NVIDIA is not as affected by the demand for business software. However, it is not impervious. Cloud computing firms may soon reconsider their present hardware expenditure levels if businesses cease requesting AI solutions. Since NVIDIA's data center division, which is dominated by its sales of cutting-edge chips for generative AI, accounted for over 88% of its second quarter revenue, this poses a serious risk to the company. Even if NVIDIA might be able to get past its immediate problems and add value for investors, its days of rapid expansion appear to be coming to an end. Therefore, unless you already have a sizable sum of money to invest, it is unlikely that this $4.1 trillion firm will make you a millionaire. Huawei Technologies formally presented its multi-year ambition to challenge NVIDIA's dominance in a booming market on Thursday, showcasing new technologies ranging from memory chips to AI accelerators. The company's new SuperPod cluster designs, which will enable Huawei to connect up to 15,488 of its Ascend neural processing units for artificial intelligence and run them as a cohesive system, were the centerpiece of the presentation on Thursday, according to rotating chairman Eric Xu. Next year, new generations of Ascend chips will be used in the construction of those SuperPod goods. Without specifying who will manufacture the semiconductors, Xu stated that Huawei will be releasing a new high-bandwidth memory along with the next-generation Ascend 950 series. In addition, Huawei intends to release the Ascend 960 in late 2027, followed by the 970 model in late 2028. According to Charlie Dai, vice president at Forrester Research, this marks a critical turning point in China's protracted AI chipset sector. This accomplishment is a result of advances in local fabrication capabilities, connectivity technology, and system design. It denotes a greater drive for independence and adaptability to export limitations. Huawei, a Chinese chip designer based in Shenzhen, is the most promising candidate to develop substitutes for NVIDIA's dominant AI hardware. Beijing recently instructed its largest tech businesses not to utilize NVIDIA's RTX Pro 6000D, a graphics card for workstations that may be repurposed for AI applications, after Washington for years banned the shipment of NVIDIA's best goods to China. The action was a blatant attempt by Chinese authorities to wean the nation off of NVIDIA hardware and promote homegrown substitutes. Similar to its rival in the US, Huawei is creating systems that integrate many AI chips into more powerful clusters. According to Xu, the recently revealed Atlas 950 SuperPod will have 6.7 times the processing power of NVIDIA's next NVL144 devices. Using the new SuperPod technology, Huawei is also designing a supercluster with roughly 1 million graphics cards. Ren Zhengfei, the creator of the business, told People's Daily, the state newspaper, earlier this year that although Huawei still trails behind the US in terms of production from a single chip, it can still get the desired outcomes by using cluster-based computing to make up for it. The aggressive strategy enables China's premier AI chip manufacturer to extract more performance from its semiconductors, which are limited in their ability to manufacture advanced fabrication because of trade prohibitions on cutting-edge equipment. Huawei's answer is the most recent move by Chinese companies attempting to create domestic substitutes and mitigate the effects of US sanctions. even though it falls short of a significant advancement in semiconductor technology. The belief that the country's top tech companies are steadily advancing their domestic AI and semiconductor development has caused Chinese tech stocks to soar in recent weeks. Companies like Alibaba Group Holding Limited and Baidu Inc. have gained significant customers for their proprietary designs, and Cambricon Technologies Corp., which is seen as a stand-in for the nation's AI chip industry, has witnessed a sharp increase in market value this year. Chinese authorities have taken a number of actions, including discouraging businesses from utilizing NVIDIA's H20 chip, which is intended for AI workloads. The guidelines have had a chilling impact even though they fall short of a complete ban. NVIDIA stated last week that it has not carried out those shipments, even though it had official approval from Washington for certain H20 exports. As a result, local chipmakers like Huawei and Cambricon have a larger hole in the Chinese market to fill. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.